This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi there, welcome to the AJ Bell Money and Markets podcast. I'm Dan Coatsworth. Today we've got a really packed episode for you with some really interesting stuff to talk about. So joining me this week is Laura Suter. Hi there, Laura.
Hi Dan. Yeah, we've got a lot to cover today, from the latest inflation data to moves in the stock market, including Nvidia becoming the world's most valuable company. And now all of the manifestos are out. We've got some updates on what each political party is promising in the election. So let's dive right in.
Yeah, I think let's kick things off with inflation in the UK, finally hitting the Bank of England's target of 2%. So I guess what's been driving that change?
Yeah, so we've gradually seen inflation drop as some of those price rises that we saw previously have started to ebb away. This month, particularly, we saw food prices, in some cases, drop fairly significantly. So the price for things like bread, cereal, vegetables, even chocolate dropped in comparison to the previous month. Now, of course, we're still seeing much higher prices for lots of those items than we were a year ago, but month on month, those figures have dropped. One thing to flag, though, is that core inflation, which is another measure of inflation that strips out some of the more volatile elements like food and energy, that is still higher than the target, higher than where the Bank of England would like it to be, and is proving quite sticky. As is services inflation. So that is still hovering around 6%, and so is much higher than the Bank of England would probably want it to be.
I guess the Bank of England's always talked about its decisions would be influenced by the data it's got. So we have this data that says services inflation is higher than what the bank wants it to be. So, as we're recording this, we've just had the Bank of England say, no, this is our latest interest rate decision. What did it decide?
Yeah, so it stuck with holding rates again at 5.25%, which was widely expected going into this. So even though we've hit that headline 2% inflation rate, which has been talked about so much as this milestone that we need to get to before the bank will cut rates, it clearly still has some concerns about that core inflation and about services inflation. But we also have the large elephant in the room, which is the general election. And it's unlikely that the bank was going to cut rates while we're in the middle of that general election campaign, partly because the bank won't make any statements during the general election campaign. So even though it's not a government organisation, it kind of has this self-imposed ban on making any statements, which means if it had cut interest rates, it wouldn't have been able to come out and explain its thinking, explain the path for inflation. So that's one of the reasons why it was very unlikely we were going to see a cut today. The other is that the bank will want to see who ultimately wins the general election and what their economic plans are, because that will have an impact on inflation and therefore interest rates. And so it was very likely that they want to see the outcome of that, have some more certainty around the direction for the UK economy, as much as we can have certainty around that, before they pulled the trigger on that first rate cut. So it means all eyes are now on August, because there is no Bank of England meeting in July. So we're now focused on August as a potential for the first rate cut, or potentially September, depending on what happens with politics. But now let's go to markets. So let's go to the tech sector first. So Nvidia has become the world's most valuable company, which is quite the leap, quite a meteoric rise for this company. So Dan, talk us through.
Yeah, so it's now worth $3.34 trillion. I reckon if you'd said to friend or family 2 years ago, oh, Nvidia, the average response would be, who? It's amazing how, I think it really is amazing how this company has, I think if you follow the gaming sector, or if you knew a lot about the tech sector, you would have been aware of it. But for the average person, it's only the last couple of years that really got on people's radar. The share price has been going bananas because it specializes in computer chips, and these are being used to help companies to have more processing power. So if you just think about lots of companies, across pretty much every sector you can think of, is looking at AI. How can we deploy this to make ourselves more efficient? Do some tasks that would free up staff to do other things, and so on. So we've seen huge spending on AI in the last couple of years. Nvidia is right at the center of this, and of course, investors have sort of said, clear theme here. How do we play it? Nvidia is the sort of seen to be by so many people the go-to stock. So its share prices kept going up and going up. What's interesting is that it makes lots of money, and those earnings expectations keep being smashed. So essentially, the more it comes out and says like, yeah, once again we've beaten expectations, that's a key driver of the share price, as well as everyone's sort of saying, okay, I want to get involved in this as well. I want to play the AI theme. Fairly recently, it did something, a technical thing called a share split. So essentially, it did a technical thing that made its share price a lot cheaper, even though it didn't affect the whole value of the business. It meant that rather than paying a sort of more than $1,000 to buy a single share, it's now just over. Divide that by a factor of 10, so it's much more affordable to people. So I think all these things combined have sort of have led to Nvidia, and it's just now leapfrog over the likes of Microsoft, Apple, to say become this really, really big champion company. So I guess, Laura, go back 2 years ago? Were you I bet I reckon you're a gaming geek. You probably already knew it, didn't you? So.
I had never heard of Nvidia at that point. No, so you're right, I think. And now it's become, because there's been so many headlines about it, about its rise and about the value increasing. Now I would bet that most people know it. But do you think that the valuation is kind of sustainable? There's obviously been some warnings about an AI bubble and lots of stocks rising in value just because they've talked about AI in their results. So is this kind of a bubble that might burst, or is this a sustainable rise in the valuation of the company?
Well, I think the gut feeling is this is a clear trend, and there is change happening, and companies are demonstrating that they are spending money on AI. So it's not people guessing that we might see something in the future. It's happening now. The trouble with Nvidia is it's got to keep beating expectations in order to be able to sort of to potentially expect a share price rise. I can't tell you what the share price is going to do tomorrow or the next day. But it's we're not here to give any sort of advice or forecasts. But I think we've had Nvidia's beaten earnings expectations for the past 6 quarters in a row. Not many companies can say that they've done that. It is making real money. But there was a really interesting article in the Financial Times a few days ago that sort of put the spotlight on what's actually happening with AI related stocks on the market. So there's an investment bank called Citi. They've got an index they call the AI winners basket. And to be in this index, it's names that have had the most excitement amongst its clients over the last year. So last year, more than 3/4 of the names in this basket saw their share price rise. This year, so far, more than half of the stocks are down year to date. That suggests we are seeing a real shift in the market and how investors are sort of looking for AI companies. And it's not just this sort of Citi basket. If you look at some of the tracker funds that specialize in things like robotics and artificial intelligence, a lot of them have seen holdings that have declined this year. And you're right to sort of suggest, is this a bubble? I've seen a couple of people make this comment as well. One of them is a guy known in the sort of investment industry called Rob Arno. He said one of the classic things about bubbles is that you see smaller companies fade before big ones suffer. And he was sort of quite positive on AI, but he said like a lot of these benefits are going to come gradually from using AI, but the market's pricing them in as if they're happening and the benefits are now. And I wonder whether at this point where investors are sort of looking much closely and saying, I don't want jam tomorrow, I want jam today. And if they're not getting it, there might be this clear explanation for why we're seeing disparity in the market for AI stocks.
Interesting. Definitely one that we will be keeping an eye on and coming back to time and again, I'm sure. But next up on markets, let's talk about supermarkets. So Dan, what's happening with the market shares of different supermarkets? We know that they've changed quite a bit during that cost of living crisis. So what's the latest?
Yeah, there's a research group called Kantar which issues data on a regular basis just about what's happening with supermarkets. So you might have seen the headlines, this week, which was all about we've had a really hot, sort of wet period, and you're seeing that impact grocery sales. People perhaps they're visiting supermarkets less often, and of course this is sort of it's bad news, but it might only, obviously this is only a sort of temporary thing. But if you look closely into this data, it shows actually, even though there's a difficult backdrop, there's been some clear winners and losers. And 3 of the 4 companies that have seen the biggest market share gains in the 4 weeks to the 9th of June are on the stock market. They are Tesco, Sainsbury's, and Ocado. The other one that's not on the stock market is Waitrose. So I think this is quite interesting here. So you've got, Tesco and Sainsbury's have been, going really hard to try and compete against Aldi and Lidl, pushing their sort of loyalty schemes, so the Tesco Club Card and Sainsbury's Nectar scheme, as a way that if you use those cards, you get cheaper prices. Ocado and Waitrose, you think, okay, this is not quite what we've seen in sort of recent years, because the cost of living crisis has meant people are really watching their spending. Lots of people have been trading down to cheaper stuff. So Tesco and Sainsbury's have been fine because they've got like a really good value range. I think that we're seeing the early signs of people starting to trade up. They've perhaps been a bit bored of the value stuff, and they want to treat themselves. And if they think that they've got sight of interest rate cuts potentially coming later in the year, maybe they're feeling a bit more confident about their finances. But equally, at the same time, if you dig into this data, it shows that Asda and Co-op are really struggling. They're the big losers. I guess if Asda's always been the one to say, we're at the value end of the market. So Aldi and Lidl kind of eating its lunch. You've got Sainsbury's and Tesco pushing hard on value. Even Marks and Spencer, not really known for value. It's been cutting prices on sort of a core range, and it's doing really well. So poor old Asda in the corner is just getting put to one side. And I don't know about you, Laura, but if you shop at Co-op, I mean, they're sort of mostly known for convenience stores. Their prices are really expensive. Do you ever go there at all?
Yeah, they're so expensive. And I partly put that down to the fact that whenever I go in one, it's kind of a convenience store environment. So you kind of expect to pay a little bit more there. But yeah, it's so pricey. And I don't feel like, and this is obviously just my opinion, but don't feel like they're known for the kind of luxury or quality. So for Marks and Spencer's and Waitrose, it's going to be a bit more expensive, but you feel like you're getting a very quality or even a luxury product for that quite a lot of the time. Whereas Co-op, maybe because they're associated with these convenience stores, don't have quite the same connotations, I think, to justify those higher prices.
Yeah, I mean, there's plenty of companies in the supermarket sector do convenience, and so whilst you think that Co-op might think it can get away with it because it's got the convenience factor, you just pay whatever it's because you just want to pick up something perhaps on your way home from work. Lots of other places are there to offer you the same sort of thing, potentially at cheaper price. So yeah, so interesting stuff. So I was just thinking, it's probably a couple of weeks now until the general election. We kind of, the market seems to have a quite strong view about who might be winning this election, but we've had all the sort of the manifestos published. So I think it's probably quite a good time to perhaps take a step back and think, how might this affect us and our money? So, I mean, Laura, I know you're having a look at sort of what each of the major parties have been saying on things like tax and spending, but what's the sort of the key takeaways there?
Yeah, and I think we'll just cover kind of some of the headline policies because we don't have half an hour to set aside for me to go through each of the manifestos and what it might mean for your money. I think we might lose a few listeners if I did that. So I think let's just go with some of the key themes. So the first is that among the major parties, we are not seeing a pledge to kind of end that freeze on income tax bans. So Conservatives, Labour and Lib Dems all are either have said that they're not going to end that freeze or just haven't talked about ending that freeze. So that means that we're still expecting the threshold for personal allowance and for higher rate tax to remain as they are until 2028, which is obviously going to represent a huge increase in taxes for individuals. Lots have kind of come out and said that they're not going to raise taxes, but by not ending that freeze, effectively you are paying more tax than you would have otherwise done had those thresholds been linked with inflation. The only other kind of significant change, I guess, when it comes to income tax thresholds is Conservatives' plans to have this new kind of triple lock guarantee for pensioners so that their personal allowance rises so that they're not taxed on their state pension income. So that was only kind of the significant move we saw. Lib Dems did say that when public finances allow it, then they will raise that tax-free personal allowance, but no kind of solid time frame on that. And then we come to national insurance, which is another version of tax. And we have the Conservatives talking about cutting that headline rate of national insurance and ultimately abolishing it for self-employed people by the end of Parliament. Quite a long timeline on those. So that cut to national insurance, they've pledged to do by April 2027. So certainly not something that we would imminently get. And no mention on that from the other two main parties. I guess the other thing that's relevant to investors particularly is things like capital gains tax. There was a lot of talk about what parties would come out and say on this. It's kind of widely seen as a wealth tax. And so it's seen as one that might be relatively popular for parties to either raise the tax or to take away some of the tax-free allowances. Labour, the only mention of it was to close a loophole that relates to the pay and private equity industry, so a very niche crackdown on it. Lib Dems did have a kind of big change that they announced on capital gains tax, increase rates more aligned with income tax rates, but also kind of raise the allowance. So some bigger moves there from the Lib Dems. One common theme with all of the parties was a crackdown on tax avoidance, tax evasion. And this is an area where each of the parties is saying that they can raise a huge amount of money. I mean, the amount varies depending on the party. About 5 billion Labour is saying they can raise, all the way up to more than 7 billion that Lib Dems say they can raise through this. Call me a cynic, but I feel like if there was an easy way to tackle tax avoidance and evasion, would we not have done it by now? If there was a magical £7 billion pot sitting there that a government could have tapped into, it feels like they may have done that already. But it is obviously a popular thing to crack down on. No one is really supporting people who are evading paying their tax bills, and it's one where you can potentially generate these kind of huge amounts of money to help plug gaps elsewhere.
So I guess if you're employed by HMRC, are you living in fear that you're going to be pushed hard? Find us more money.
Exactly.
Yeah.
But that also comes at a cost, whether that's, employee cost of hiring more people to crack down on this, or, I'm interested to see how that actually pans out, depending on who makes it into number 10, how much they ultimately do generate from that crackdown. Because I feel like at every budget and autumn statement that we've had in recent years, that there's been pledges to crack down on tax avoidance, and but maybe I'll be proved to be wrong. Maybe I'm being pessimistic, Tan. I think probably the other area to touch on is stamp duty. So the Conservatives have said that they will maintain the stamp duty breaks that first-time buyers get. So this is the current scheme where first-time buyers don't pay stamp duty on properties up to the value of £425,000, and then there's a further kind of break up to around £600,000. That's due to end in April next year, and they said that they will make that a permanent change. Now, interestingly, Labour didn't have that in their manifesto. Now, that could be because they're planning to increase that stamp duty for first-time buyers, or it could be that it's just not something that they've kind of considered or factored into the manifesto. So they've not explicitly ruled out extending that, but they've also not explicitly promised that they will maintain that kind of stamp duty break. Instead, what they talked about was increasing the stamp duty on purchases made by non-UK residents in a move to raise a little bit of money.
Brilliant. Should we talk about banking hubs? What do you know? What do you know about banking hubs, Laura? Are you aware of the concept?
Yes, I've heard of them. I've never actually used one. One that I did see the other week was this mobile banking hub. So it's kind of like a van or a bus that goes around to different communities, and you can go and do your banking in the back of a bus, which is a bit weird but very convenient, I think.
Yeah, I mean, I think it's definitely an issue for people who don't live in sort of city centres. We've had lots of closures on high streets of bank branches in recent years, and that trend is just still in motion. So it's quite interesting that Labour set out plans for 350 banking hubs to be open in towns and villages across Britain over the next 5 years if it wins the general election. So, I think when I was thinking about banking hubs, my initial thought was, okay, is it just like going to the post office and saying, I already know I can do that. I can pay in a check there. I can get money out. But then I thought, there's some reference to staff from different banks sort of sharing the same space. I thought it's a bit odd, but actually, so I've done a little bit of digging, and okay, it's not as complicated as I was thinking. So, I think the idea is that you can go into like a post office. The post office worker would do the sort of the basic administration things like if you want to pay a bill, deposit a check, and withdraw stuff. But if you need to speak to someone from a bank about something a bit more specific to a certain product type or something to do with your account, the way it would work with hubs is that each bank that's participating will take turns. So, say on a Monday, you might have someone from Barclays. Tuesday, it might be NatWest. Wednesday, Lloyd's, and so on. So, I think that's quite an interesting way to do it. So you'd have an opportunity to meet face to face with someone from your banking provider, assuming that you use one of these sort of probably the big names that are taking place. But I guess it's all down to will they publish a timetable to show who's there and when? Otherwise, it might be a bit chaotic if you turn up and you find that you start talking to someone about a financial product and your account and realize actually you don't actually bank with them. It's the wrong person. But I guess the concept's quite good. But it goes back to I know there've been banks trying to cut costs, make themselves more efficient, but there's a clear need for these branches. I live in the south of London. I went into a NatWest branch a weekend, and there was someone there, but they said, "Oh, sorry, on Saturdays we can't. You can't ask." I wanted to close down an account. I couldn't do it. I have to do it on Monday to Friday. Can't do it on a Saturday. And it's just little things like that. It's just so damn frustrating.
And it's inconvenient, I think, for people, even this banking hub, that's great. But what if you work on the day that your bank is appearing in that banking hub? It still doesn't feel super convenient, does it?
No.
But it's an interesting concept because obviously not every bank can afford to have a branch on every high street anymore because they are so underused. I see the dilemma for banks, but it does feel like there's this whole section of society that's now not served because they're not online savvy, they're not online banking, they still want to go into branch, but they have to drive 50 miles to the nearest branch now.
So while we're still on the subject of banks, I just wanted to bring up something about Barclays because they got a lot of attention a while ago by launching something called a Blue Rewards scheme. And it was all quite exciting, but as is the way with the banking industry, there's some changes to this Barclays scheme. Customers are not happy. So, Laura, what's been going on here?
Yeah, so this is the Barclays Blue Rewards scheme. So previously, customers paid £5 a month for the account, but that got them access to some high interest savings accounts and cashback, and then they would get £5 back as long as they had 2 or more direct debits set up. But now Barclays is changing the scheme, and so they will no longer get that £5 kind of loyalty reward. Instead, Barclays has switched it so that customers can get access to Apple TV Plus subscription and also watch Major League Soccer matches with an MLS season pass instead. Barclays says that, you know, it's reviewing the accounts to make sure that customers get good value, and it's switching to perks that it thinks customers will enjoy more, so entertainment ones. And we see that from other banks. I mean, Lloyds has a kind of reward, the Club Lloyds account, which offers access to things like Disney Plus or cinema tickets. So it's very much along the similar lines of what Lloyds has been offering. But like you say, customers are not happy that their reward is being taken away.
I guess if you know, I don't know what an Apple subscription is. I think it's pushing 10 quid, isn't it, a month? So essentially, if you're a fan of Apple TV, you can get it for 5 quid, a month this way. But I wondered if they'd gone for Netflix, there might be less grumbling. I think people are sort of saying that Apple TV is the niche one of the pack. And the idea of, like, would you like to watch a load of American teams playing football, not American football, but soccer, isn't it? So again, is that really mass market sort of rewards? I guess the current providers have been chasing business in recent years, and there's been a real push to try and hoover up more customers there. So I presume that Barclays, did really went in very generous with this scheme, saying, like, come on, be a loyal current account customer, and we'll give you really good savings rates if you agree to do this. And actually, it was a no-brainer, wasn't it? You look at you get charged the amount of money, but they'll give you that back in cash every month, so it equals it out. Now the things are changed, isn't it? So current savings rates are probably, as interest rates get cut, savings rates will be trending downwards. Do these banks think, okay, maybe we need to concentrate on other products in order to offer sort of certain incentives? So I think generally what I've been reading about this is quite a backlash from Barclays customers on this one. Saying that you've been messing with us, and let's see. They might do. You never know, do you? They might do a U-turn and change their mind. So I guess if you're,
but I think, like you say, I think, as we get closer to interest rates being cut and then them actually being cut, I think we're going to see more of some of these kind of attractive perks that banks have launched to lure customers in. We're going to see more of those withdrawn. I mean, the obvious one is obviously on savings rates, which we've already seen a bit of, but we'll also see it in terms of these kind of perks or cashback offers or things like that banks have offered customers that they then start to wheel back on. Now, one of the things that was covered in most manifestos was making the UK a more attractive place to do business and also boosting the UK stock market. So we thought we'd get an expert in to talk about this. So Neil Shah from Edison is going to talk about how to improve the UK stock market and make it more attractive.
So, Neil, thanks for joining us. I think if we could start off just by taking a sort of step back and saying kind of what's wrong with the UK stock market at the moment. Is it a simple way of describing it? Is that people are finding more excitement in other parts of the world, particularly the US stock market? There's not really a lot of new companies coming on to the UK, and then just a sort of general sort of feeling that there's not a lot going for the UK. I mean, is there an easy way to fix it, or is it quite a complicated situation?
Well, I think it is. There's a range of factors causing it, and I think you require a proper understanding of the range of factors to help fix it. Let's categorize them in terms of some structural. So what are the structural issues? Structural issues is that actually global markets, have been influenced by policy, which is directing people to lower cost investment options. And you have seen the sort of growth in ETFs and passives. And, you can see chart after chart of, how much money is going into those. That has an implication in terms of the underlying liquidity of the market. Because when you're buying an ETF, it doesn't necessarily translate into actually trading in the underlying security. You've seen some structural changes in terms of the capital requirements for banks, and actually what's happened on the market making side has meant that the market's a lot thinner, and as a result of that, what you're finding is that there is more volatility in the market. The natural response to that is to try and move up the market cap scale. And this is something that you're seeing everywhere, all right? So where is the flow of money going to? It's the Magnificent Seven, the very large stocks. Why? Because in a slightly thinner market, you want to be able to get out of things as well as be able to get into things. But you're also seeing, we have done work on UK funds, and what we've seen is that the average market caps of the businesses that they're investing in has gradually moved up actually fairly significantly. And some of this is this liquidity requirement that they post Woodford, they need to demonstrate that they're not in illiquid securities. They can sort of liquidate, and the UK in particular has been faced by several, nearly 3-4 years worth of redemptions. And so if you're a fund manager, you need to be able to, if you need to return capital, you need to be able to get out of positions. So that, I think, has contributed, structural reasons. Cyclical reasons, we have just been through an inflation and energy sort of crisis, and the UK structurally was perhaps not as well sort of placed as some other markets. And I think it was natural for people to want to sort of step out of the UK market as well. And then I think the other thing which is sort of has been contributing to difficulty in the UK, as while active management has seen sort of continuous outflows, the pension funds, which are sort of the sort of growth of permanent capital, and lots of people have identified this, have been reducing their holdings to UK pension funds have been reducing their holdings in UK equities, and that has led to a sort of steady stream of selling of UK equities. And I think these three things combined have led to London looking like an undervalued market. And lots of people have sort of commented on the fact that, from a valuation perspective, this market looks, considerably more attractive than, say, the North American market.
So I guess we have seen a wave of takeovers. So there is, like you say, a recognition that things are really cheap. That might resolve part of the problem, but what in terms of sort of bringing the focus back on the UK market, what else do we need to happen to make the UK, I guess, more attractive for more companies to join us? Is that we have to see a complete overhaul of sort of the listing rules, which I know is partially underway anyway? Or is there other things that we have to see as well?
Well, I think that there's clearly listing rules are sort of causing friction in terms of companies coming and listing on the London market. And two notable examples of listings that were missed. So Arm, chose to list in the US, and some of that was down to disclosure regimes required in the UK versus the US. London Tunnels, which is actually a tourist attraction in London, ironically, is choosing to list in Amsterdam on Euronext Amsterdam. And that was difficulty effectively in terms of it's a unique asset, difficult to establish valuation from some peers. But that's what a risk market is about. That's what a market is meant to be. And I think this sort of appetite for risk needs to return. So I think the listing reforms will help. They will broaden, hopefully the cap on retail investors investing in new issues is removed, and that will broaden out the pool of capital available. It will encourage sort of entrepreneurs to list as well, giving them a little bit more flexibility in terms of the requirements to come onto the market. The bigger issue, I think, and if you go back to the Mansion House reforms, what was the government trying to do? It was trying to do two things. One, it was trying to stimulate demand for UK equities, and that was looking at two things. One, revitalizing the retail investor, and two, generating demand out of UK pension funds for UK equities. The second was to actually provide, better quality information, and a lot of what Rachel Kent sort of set out in her paper was trying to address that. There is this, I can't phrase it the way she did, but the golden thread effectively was this idea that if you get great quality information, you'll get a better assessment of these companies, and hopefully you'll start to get the valuations that will attract companies into this market.
So, I mean, we've got another sort of suggestion is, if we have to pay stamp duty on shares at the moment, if you remove that, that might make things more attractive. Do you think that we might ever see that, or actually that won't move the dial even if it happened?
No, I think it's a genuine factor. I mean, I know a number of people who prefer to trade in US or other securities because they see the friction cost of stamp duty. And it is something that, if you can remove, it would help in terms of the liquidity of the market. The problem, I think, is to remove it requires, it's not easy to do. That is something which requires legislation, takes time to work itself through. And I think my general sort of frustration, I guess, about the UK market is there's lots and lots of good ideas. Go back to the Lord Hill review, etc. The Mansion House reforms, etc. Very few of those have actually been enacted, and there's a feeling of you need a certain speed of change and action to see the market revitalize itself.
Yeah, I mean, if Labour gets into power, the general election, if you just have to look at their manifesto, they do mention a desire to get, particularly pension funds, to be investing more in UK assets. And what can they do to help people? I mean, do you have a sense that if Labour get into power, are they going to sort of make this a priority thing? And what might they do?
I think so. I mean, look, I think that probably the biggest sea change that I saw over the last 12 months was this idea that this buy-in at government level, that an active functioning capital market is actually good for the productivity problem. There's been lots of academic work that says that if you've got a good stock market, if you're able to attract capital to the SMEs, that leads to growth and productivity and employment and improved tax receipts, and sort of it is something that cracks the conundrum that that the UK has faced in terms of a 10-year drought in terms of productivity gain. So I think the fact that the Kent review, the discussions Treasury have been having, is that they refer to research as a public good. It's the fact that there are plenty of externalities to it. So I think they buy into this. If you read the January paper, their finance paper, the Labour finance paper, my concern about it is that while they agree with a lot of the findings, there's still a call for a number of commissions to review it. And that to me suggests that there's just more delays on the timetable.
Yeah, I guess it's. I'm not sure. I'm not sure what we can do really. Just to expect. We shouldn't expect a big change for everything to be rushed through, do we? But yeah, I guess it is a bit inevitable that everything likes to go through consultations, doesn't it? So, I mean, do you even think?
I hope that I mean, I do remember that you may remember that when Tony Blair won, actually pretty quickly they sort of hit the ground running and took some very bold sort of steps, including the independence of the Bank of England at that point in time. So if you've got a long enough memory for that, and I really hope that if a decisive majority and a government that's empowered to make change, if that is what the polls are suggesting, it gives me some hope that actually you might actually see some change being implemented relatively quickly.
That was Neil Shah from Edison. Now let's turn to Canada. So Dan recently spoke to Dean Orrico, who is manager of the Middlefield Canadian Investment Trust, about the impact of interest rate cuts in Canada, but also the similarities that can be drawn with the UK market. So let's listen to what they had to say.
Well, Dean, we've just, as we're recording this, we've just seen Canada become the first G7 nation to cut interest rates in this cycle. I just wanted to ask you, is this good for you as a Canada focused fund manager, and kind of what does it mean for perhaps what's in your portfolio at the moment, and maybe does this open up opportunities to look at things that you haven't looked at because interest rates have been high for the last couple of years?
Canada, generally speaking, I think is in good shape from an economic standpoint because we're not looking at a hard landing. And what we've seen over the past several months is that you've seen a more normalization picture in respect of both demand and supply, which we think really got out of whack on the heels of the pandemic. So the other thing to keep in mind here is that Canada took its medicine early on the interest rate increase in the summer of 2022. Actually, we increased rates by about 100 basis points. So I'm not surprised as a result that inflation came down a little quicker in Canada, and you're now seeing interest rates come down again. So Bank of Canada cut a few days ago. Next meeting's on the 24th of July, and then again in September. And between July and September, we think you probably get at least another quarter point cut here. And over the next 12 months, you could see the overnight rate from 4.75% today, probably down to closer to 4% or maybe even 3.75. That's kind of how we see it unfolding. The other part of your question, Dan, is that how does that impact our portfolio? And Canada, generally speaking, say unlike the US, is a bit more like the UK, where we've got more mature businesses, i.e., less growthy industry. So we really don't have in the public markets a tech sector. So they're more value and cyclical, and they pay higher dividends. So as a result, this reduction in interest rates, we think not only helps their balance sheets because they tend to carry a bit more leverage than, say, a growth company would, but maybe more importantly, we think it really affects investor sentiment because I think one of the biggest impediments to investing in the sectors that we have exposure to in our fund has been higher rates, i.e., investors have been sitting in 5 and 6% high yielding cash like instruments. Now, those yields are no longer going to be available, beginning earlier this week and later on, because we think you're seeing both the short end and even the longer end start to come down. And we think that money flows back into some of these equity income securities that we own in our fund.
It's got a lot of similarities with the UK then as well. We've got, I guess what people call value stocks, boring stuff, a lack of tech. And we've certainly seen lots of investors. No, well, I say there's the accusation they've been hiding in cash, but they've looked at cash and realizing that they can't, they don't have to take a lot of risks to be in cash compared to other risks being in the stock market. So yeah, I think that's very interesting. So what about stuff that's over the last couple of years with interest rates higher that you thinking, okay, well, this is not the right time to be investing in these type of things. As rates come down, what's kind of on your radar now, thinking going, oh, maybe there's a certain sector we could have a look for some opportunities here?
Sure. So let me first address this similarity and maybe a bit of a contrast with the UK. You're right that we've generally become a bit more service oriented. We don't make a lot in our country, kind of not unlike the UK. The size of our stock markets are quite similar. Having said that, I think one of the biggest differentiators between Canada and the UK is our abundance of natural resources. And when you think about Canada, you think often about commodities and in particular oil and natural gas. And those were bad words from kind of 2015 to 2020. And we think that's changed now because of a few things. One, the war in Eastern Europe, and then more recently, the war in the Middle East, where I think investors are now coming to appreciate the value of a secure and stable source of power and sources of natural gas. You no longer can rely on Russia for providing natural gas to Europe. So I think the sentiment on natural gas in particular, as well as oil, I think is vastly improved. And then that got another accelerant in the last 6 months because we know AI and the demands on power from AI, and now this increasing focus on data centers to basically house the data and the power generation for AI and now becoming more reliant on natural gas and realizing natural gas might be, along with maybe nuclear, the only viable sources of power for this incredible demand from data centers. So when I think about Canada, I think this abundance of natural resources, which is in essence almost been a bit of a headwind from 2015 to 2020, I think is now going to become a tailwind. So when we talk about the energy transition, we think this is more of an energy evolution that's going to play out over decades, and we think natural gas is really going to be a critical fuel. And when you think about Canada again versus the UK, we've got this abundance. So basically, petrol costs in Canada are 30 to 40% cheaper than you pay in the UK. Electricity might be 50 to 70% cheaper in Canada versus the UK. We're a net exporter of these things. You're a net importer. So I think that's a real point of differentiation. And then back to your question, we've got that type of exposure in this portfolio. So some of our natural gas producers or our pipelines, which gather this natural gas from the producer and bring it to the end user, are becoming more and more in demand. So companies like Enbridge, companies like TC Energy, we think those are valuable companies still trading at substantial discounts. And then we think the market is finally coming to appreciate, really in the last 6 or 12 months, but we think accelerating going forward, how valuable these businesses are.
Obviously, you've got a Canada focus, but within your investment trust, you are allowed to invest in the US as well. Given that we've got a presidential election coming up in the US, what does that have a bearing on the decisions you're making in terms of sort of fishing for US stocks to own? And perhaps, if Trump gets back into power, is there anything that you think, okay, well, I definitely don't want to own this, or perhaps I want to own that sort of thing?
Yeah, great question. And we sit around our office, we have our weekly portfolio management meeting on Tuesday mornings, and this is usually at the top of the agenda. How does this inform how we allocate capital? Because you're right, in Middlefield Canadian, we can go up to 40% non-Canada, and that's really 40% in the US. And you look back over the last 10 years, there have been some periods where we've been 30 to 35% US. Today, we're relatively modest percentage in the US market because we just see better value in Canada. So, in respect of the November election in the US, we really don't think it impacts us in any significant way. Recall that when Trump was in office from 2016 to 2020, we renegotiated the free trade agreement between Canada, the US, and Mexico. So if Trump gets reelected, we don't think that issue is going to surface again because that became a bit of a headwind, not knowing how it's going to impact Canadian businesses. So that's now been settled. With Biden, we think it's probably more of the same. We know there's more of an inclination for Biden to favor renewables, but clearly, just given the need for increasing amounts of baseload power, we don't think there's much he can do in terms of trying to shut down natural gas. So by and large, we think our portfolio is really unchanged, regardless of who's occupying the White House come January of next year. The one sector that we think historically has been impacted, but we don't think there's a major issue now, is healthcare. And from time to time, we do have exposure to healthcare. That's one of our areas of expertise here in Canada. We run a number of healthcare strategies for Canadian investors, and most of those healthcare businesses are located in the US. And you might recall several years ago that there was concern about drug prices, and then big pharma companies really were derated as a result of that. We think most of that noise is now behind us, so that shouldn't preclude us from looking at the healthcare sector. In fact, it's a sector we really quite like, regardless of who's in power in Washington.
And what are the valuations like in healthcare? Because I think a lot of people get excited about any company that's linked to weight loss treatments at the moment, but obviously most of these businesses do lots more than that if they are involved in that sector. Is it an expensive sector to invest in, or are there some bargains out there?
Yeah, so it's a great question because when you think about the GLP-1 drugs, in particular the drugs coming out of Lilly and Novo, not surprisingly, those are among the highest valued companies because of the enormous demand for those weight loss drugs. And we think we're still in the early innings of that. We think there's lots of runway there, notwithstanding the valuations that those companies are trading at. However, when you look at the sector as a whole, we still think it's attractively valued. And the area that we really like at this point is the med tech sector. And again, you're finally starting to see the true impact of an aging population and its corresponding demand for various types of hip replacements, knee replacements, and a lot of the med tech businesses that are servicing that part of the market, we think are finally now starting to come into favor. So overall, we think the valuations are really quite attractive. Putting aside the higher valuations on some of the sexier areas like the GLP-1 area, but overall, we think it continues to be a sector you want to have exposure to.
Well, great. Well, Dean, thank you ever so much for talking about what you're up to at the moment. Really good to talk to you.
Likewise. Thank you, Dan.
Some really interesting parallels there from Dean, but that is all for today's episode. We covered a lot of ground, from inflation targets to tech giants to political promises and banking changes. Thanks a lot to our guests, Neil Shah and Dean Orrico, for joining us as well.
And thank you, our listeners, for tuning in. So don't forget to subscribe and leave us a review wherever you listen to this podcast, and we'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.